Okay, so good evening, everyone. How are we all? Very good evening, everyone. Are we all good? Fine. So we were doing the chapter of capital structure in our last lecture, and we have covered like 4 concepts in that. One is regarding the net income approach. Then we had the net operating income approach, followed by traditional approach and Danny Miller with the taxes approach. Right. So we have covered like these all concepts now. We are yet to do one more concept, one more capital structure theory, which is Modigliani-Miller arbitrage model. So the model that we are yet to do is Modigliani-Miller arbitrage model. Okay. Now, when we talk of this Modigliani-Miller arbitrage model, what are we really talking about? For that, we need to understand the term called as arbitrage. Have you ever heard this term called as arbitrage, guys? Have you ever heard this term called as arbitrage? Yes or no? A term called as arbitrage. Have you ever heard it? No? Yes or no? Arbitrage as a word. No? Arbitrage, abridged prospectus. No, not that abridged prospectus. I'm talking of arbitrage. Okay, so let me just explain you what is the arbitrage thing first. So, what's arbitrage? Suppose there is like NSE and BSE. These are the 2 stock exchanges. So current market price in NSE is, let's say, 1023, and in BSE you see that it is 1025. So in NSE the current market price is 1023. In BSE the current market price is 1025. So when you see this particular situation, what action will you take? What action are you going to take when you look at these prices of NSE 1023 and BSE 1025? Yeah. What action comes to your mind when you're looking at these 2 numbers? In one market, the share is trading at 1023, and in another market, the share is trading at 1025. Correct, guys? Now, when you do this, you actually make a profit of 2 rupees, and that too, it's a risk-free profit. You're going to make a profit of 2 rupees, that too, it's going to be a risk-free profit. Okay, riskless profit. Because you're going to buy in one market, you're going to sell in another market. So that's essentially not leading to any sort of disparity or any sort of risk that you're facing. Okay, so what we are doing is we're essentially buying in one market and selling in another market. We are buying the share in the undervalued market and we are selling in the overvalued market. So the market where we find that the share or the underlying or anything is overvalued, we are going to buy, and where it is undervalued, when it is undervalued, we are going to buy, and where it is overvalued, we are going to sell. Okay, is this clear, everyone? Yeah, I hope this is very much clear to you. So NSE and BSE, we say there's undervaluation, overvaluation that leads to a profit of 2 rupees. Okay, now let's take an example to understand what is this levered. I mean, what are we really talking about in terms of arbitrage? So let us look at these 2 companies. We have a levered company, we have an unlevered company. Now, there is a EBIT of 20,000, both companies. Interest is, let's say, 7,000 that is being paid by this particular company. Okay. And let's say the PAT is 13,000 and 20,000. Obviously, after subtracting the interest, you will have a EBIT of, when you subtract interest from EBIT, that's going to give you PBT or PAT of 13,000 and 20,000. Cost of equity is 11.5 and 10. Can you tell me what is the value of equity over here? Can you calculate the value of equity? Can you calculate the value of equity, guys? In case of levered entity, what will be the value of equity? Yeah. For the levered entity, how can we get the value of equity? We have the formula, right? PAT upon K. The value of equity is going to be determined as PAT upon K. So when you do that PAT upon K, you observe that it is 13,000 divided by 11.5% and 20,000 divided by 10%, which is 2 lakh. Right? And let us say the value of debt is, in case of levered, it is 1 lakh, and in case of unlevered, it's obviously going to be 0. So what about the value of the firm? What about the value of the firm? So value of the firm will be value of equity plus value of debt, right? So that's how we got the values of the company. Value of both the company, value of both the entities. Now tell me, out of these two entities, which is one of them is levered and another is unlevered, out of these two entities between levered and unlevered, which one do you think is overvalued and which one is undervalued? Which one is overvalued and which one is undervalued, guys? Which one is overvalued and which one is undervalued? Yep. Which of these two companies are overvalued and which one is undervalued? Yep, tell me. Can you see the company with a higher value is obviously going to be, overvalued, and this company is undervalued. Correct, guys? Levered company is overvalued, unlevered is undervalued. Now tell me, what do we do with the overvalued company? What do we do with the overvalued company? Do we buy the overvalued company or do we sell the overvalued company? What do we do with this overvalued company? Should we buy the overvalued company or sell the overvalued company? Sell the overvalued company, right? And in case of undervalued company, we are going to buy it. So we're going to sell the overvalued company and buy the undervalued company. Right? So action is like, for levered entity, it should be overvaluation, and for unlevered, it is going to be undervaluation. So levered entity is going to be sold, unlevered entity is going to be purchased. So levered entity is going to be sold, unlevered entity is going to be purchased. Right? Now, when this course of action is being undertaken, there will be some cash flow, some benefit which will be coming in. Right? Are we really going to sell and buy anything without any profit? Of course, no. We need to see that there should be a profit. So for that, let us just assume. Let's assume that, over here, let's assume an investor who is holding 10% stake in the equity shares of the levered entity, because since the investor from a levered company is going to sell, the stake and take a position in the unlevered company, right? So we say, let us assume that investor is having 10% shareholding of the levered firm. So let's assume that investor is holding 10% stake in the equity shares of the levered firm. Okay. Okay, so let's assume that investor is holding 10% stake in equity shares of the levered firm. Now, value of the investment, if the investor is going to shift from levered to unlevered, and suppose if it is having 10% share, what will be the value of the investment that is going to be realized? So, of course, the value of equity shares is 1,13,043. For that, you are going to get 10% value, which is 11,304. And when you were an investor in a levered entity, you were having a profit of, the company was having a profit of 13,000. And since we were a 10% stakeholder, right? Since we were a 10% stakeholder, right? Since we were a 10% stakeholder, we are actually having, 10% of the total profit, which is 1,300. Okay. So 10% of the 13,000, that's going to be 1,300. Okay. So we can say levered is overvalued, unlevered is undervalued. Levered is going to be sold. When we are going to sell the shares of levered entity, we are going to realize 10% of its total value. So 10% of 1,13,043, which is 11,304. And share in the earnings of the levered entity will be like, out of total profit of 13,000, we'll be realizing 10%, which is 1,300. Okay. This is the situation which we have right now. So as of now, we have an investment of 11,304. As of now, we have an investment of 11,304, and on which we are earning a return of 1,300. Right? So are we clear with this particular aspect, guys? Yes. Are we clear with this particular aspect? So right now, what we are investors. We are investors of which company? Levered, because we are looking to sell the shares, right? We are looking to sell the shares of a levered entity and enter into buying shares of the unlevered entity. So when we are assuming that, we'll say currently the value of my investment is 11,304, and currently I'm getting a profit, or I'm getting a share of return of 1,300. I hope this is clear. Correct, guys? Is this absolutely clear? Yeah. Okay. Now let's do the things simultaneously by taking step by step. The first step would be, if I'm going to sell the shares of levered entity, I will be receiving 11,304 in my account. So I'll be receiving like 11,304 rupees in my account on sale of the shares of the levered entity. So by selling the shares of levered entity, I'll be getting 11,304 rupees. Okay, that is first part. Now, what are we going to do with this 11,304, guys? Tell me. What are we going to do with this 11,304? The money that we have realized by selling the shares of levered entity, what are we going to do with that 11,304? What are we going to do with this 11,304? Yeah. Can I say buy the shares of unlevered entity? Perfect. Absolutely correct. We are going to buy the shares of the unlevered entity. But the point is, this 11,304, which we have invested in the levered entity, 11,304, which we have invested in the levered entity, was it something on which there was no loan applicable? Was it something like there was no loan applicable? Was it such a case that there was no loan applicable? Of course not. There was loan, because if I had investment of 11,300 in the company was having a total debt of 1 lakh rupees. So my investment of 11,304 Okay, guys. Yeah. So when we were an investor in this case, that is when we were investor in the levered entity, were we having some sort of risk, indirect risk in our business? Was our investment subject to certain amount of debt risk? Was it subject to certain amount of debt risk? Yes or no? Was it subject to certain amount of debt risk? Yes. How much debt did the company have? How much debt was with the company? What was the amount of debt with the company? Can I say 10,000? Sorry, the company had a debt of 1 lakh rupees, right? Company had a debt of 1 lakh rupees. So if I was a 10% shareholder in that company, if I was a shareholder for 10% in that company, do you think I will be also, indirectly having a loan of 10% of the company? Correct, guys? Can I say indirectly, I'll be having a loan of 10% also in that company, right? Indirectly, not directly. I'm not directly liable, but in case the company defaults, can I say my capital, my equity shares can be used to pay to the debenture holders? Am I right, guys? So if the company defaults, will my investment be used by the company to repay the debt? Of course, yes. So that risk is definitely there, right, guys? So when I'm investing, when I'm switching my investment from from levered to unlevered entity, am I taking that risk with me to the other company? Am I taking that risk with me to that other company? Of course not, right? So there's no risk in that company, right? So there's no risk in that second company. So what we say is, if I'm going to switch from one company to another, I need to also ensure that the risk remains same. So instead of company having a debt, now we will say, let's say we are going to have the debt. So to match the risk of the previous investment, of the levered entity, which was investment of 11,304, we are going to match the risk, we are going to borrow at the same rate at which the first company was borrowing. So we'll say, let us say borrow at 7%, 10,000, right? Because to match the risk, I'm going to borrow like whatever company was having debt, we are going to borrow like 10% of that. Okay, we are going to borrow 10% of that. So we borrowed like 10,000 at the rate of 7%. And of course, we have realized 11,304 by selling the shares. The total funds that we have right now is 21,304. Why did we borrow? To match the risk. So how are we going to match the risk? Because the company which was earlier a levered entity, there was an indirect loan on me. There was an indirect loan on me. And due to that indirect loan, can I say we need to match the risk also when I'm switching to the other company? That's where we say the total, we are going to borrow 10,000 additionally to match the risks that we were having earlier. So total funds that we have collected is 21,304. Okay. Now with this 21,304, can you tell me how much percentage stake with this 21,304? How much percentage stake are we going to get in the unlevered company? What is the percentage stake or percentage ownership that we will get in the unlevered company? Tell me, guys. Yeah, guys. Can you tell me what is the percentage stake that we are going to get in the unlevered company? Yeah. See, I'm having an investment of 21,304 rupees. And what is the value of that unlevered company in totality? What's the total value of the company? Yeah. Total value of the company. Total value of the company is 2 lakh, right, guys? Now, out of 2 lakh, if I am investing 21,304 rupees, out of 2 lakh, if I'm investing 21,304 rupees, what is the percentage ownership that I'm getting? Absolutely correct, Boma. It is 10.652%. It's like 21,304 divided by 2 lakh. Right? 21,304 divided by 2 lakh. That gives us 10.652%. Now I am entitled to 10.652% stake in that other company. Okay. Now, can you calculate what will be your income from the investment in the unlevered company? Can you calculate what will be the income from unlevered company? Please calculate the amount of income that you're going to get from that unlevered company. Yeah, guys. What is the income? Because now, when your PAT is 20,000, out of the 20,000, you are going to claim 10.652% as your income. Right? So, share in earnings of unlevered company is 21,304. Now, of course, this is not the income that you can take away home because you need to pay the interest also on the loan. Earlier, in the previous company, the company was paying interest. Now you are going to pay interest. Right? So now this is your income from the unlevered firm. You simply look at what was the previous income. The previous income was 1,300. Now your income has become 1,430. So are you as an investor looking favorably to switch your investment from levered to unlevered? Are you looking favorably to switch from unlevered to levered? Sorry, from levered to unlevered? Yes or no, guys? Tell me. Are you favorably considering now to switch your investment from levered to unlevered? Yes. Absolutely, sir, because as we can observe, higher profit is there. I mean, my share of income is higher. So that should actually give me a higher amount of income. And this is going to motivate me to switch from levered to unlevered. Not only you, many other investors are going to undertake the same thing. They'll switch from levered entity to unlevered entity. Now, as the investors are switching from levered to unlevered, what effect are we going to see in the share prices of both the companies? What are we going to see in the share prices of both the companies? What effect do we see in the share prices of the company? Yeah. What effect are we going to see in the share prices of the company? Mm-hmm. So we see that levered company, the value of levered company will decrease. The value of levered company is going to decrease, and value of unlevered company is going to increase. Right? Value of levered company, because all investors are selling levered. So levered company share price will come down, unlevered company share price will go up. And due to this, after a point of time, there will be an equilibrium, which means value of both the companies will be equal. Right? And that's how we simply try to explain something called as arbitrage. Where the investors are going to shift from one company to another with an intention to gain profit out of it. Okay. Are we good with this, everyone? Are we all clear with this, everyone? Yes. Is the arbitrage concept clear to you? Investors are going to shift from one company to another company till they attain that level of equilibrium price. Yes, okay. Fine. So we are done with this primary arbitrage. Similarly, you can have the secondary arbitrage, where investors will shift from unlevered to levered, right? And that is going to obviously lead to increase in the income, right? And as there is an increase in income, there is a profit possibility. Investors are going to shift from one company to another, which will ultimately lead to establishment of a one single price or an equilibrium price between them. Okay, so this was the last concept which was pending. So I just thought let's just quickly get it done. Now we'll get started with the topic of leverages. Now before that, if you have any queries in this topic of capital structure, please do raise your hand. I'll take those queries and then only I'll proceed with the leverage part. You can just raise your hands if you have any queries. We'll solve that and then we'll go for the next aspect. Any sort of queries you have, guys? Any queries, guys, in this capital structure? Okay. In this example, step number 2 is not clear. Okay, step 2 was to match the risk of earlier company. Like when you were invested in a levered company, you were owning a part of equity and also you were liable for part of debt. So now when you are shifting from levered to unlevered, the unlevered company is now having no debt. So there is no obligation on you now. So when you're shifting from levered to unlevered, you're actually shifting from a risky company to a less risky company. So there you cannot simply compare the profits. Because if I want to see whether there is gain or not, I'll ensure that the risk remains the same. So to maintain the same amount of risk, with this amount of equity, there was 1 lakh amount of debt. So we can say for 11,300 amount of equity, we should have 10,000 of debt. Okay. So this arbitrage model, does it apply for both approach? It will not apply to taxation approach. So in case of where there is tax applicable, this is not going to be applicable. Arbitrage works only in case of perfect situation where there are no taxes, no transaction cost, and all such aspects. Okay. Is it clear? So shall we start with the topic of leverages now? Yeah, guys. Shall we begin with leverages? Okay. Then let's get started with the topic of leverages. In a moment, guys. Okay, so let's get started with the next topic, which is leverages. I'm not talking of this LIVER, not the biology one lever. But I think this lever you might have heard somewhere in physics, right? Somewhere in your school days, maybe 6th or 7th standard, right? So lever, have you ever heard of this? No? Okay, let me just give you some examples of lever. Example number 1. Locked it and you just pull it, and then this bottle opens up easily. Another example, seesaw. Seesaw, like you have a load over here, then there is effort placed over here, and this is a load. These are all examples of lever. There are some types of lever. There is load, there is effort, there is fulcrum. So all those things are happening. right? So that's the lever that we are talking of, right? So you put an effort, you have the load, yeah. So that's a lever. Now, what are these levers actually doing? Yeah, what are they really doing? This lever is essentially helping you to do tough tasks with ease. That lever helps in performing difficult tasks, with ease. So you can easily do some of the tasks that can be, really which may require a good amount of efforts, but with lesser efforts, you're able to get greater results. Or I can say these levers actually help you to have more results with lesser efforts. Okay, so this helps in performing difficult tasks with ease. So we can say that you're able to do more results with lesser efforts. Right? That is possible with the help of these levers. Now, when we are looking at finance, we are essentially having some concept like this called as leverages, which help us to attain greater result with lesser efforts. Right? It will help us to attain greater results with lesser efforts. Right? So how do we go about this then? How do we function for this then? So these are essentially helping us to attain greater results with lesser efforts. How is this leverage really functioning? Yeah, so let's just understand. Let's just understand with the help of certain example or certain numbers. Let us say sales units are 10,000 units are being sold, and we say sale price per unit is rupees 20. What will be the value of sales? And of course, let me just tell you what is variable cost per unit. Variable cost per unit is rupees 8. What will be the value of sales, guys? If your sales units are like 10,000 and selling price is 20, what will be the amount of sales? So sales is going to be like 2 lakh. From that, we are going to subtract the variable cost, which is 80,000. So that gives us a contribution. So a contribution of 1,20,000. The sales less variable cost, it gives you the contribution of 1,20,000. From that, we are going to subtract, let's say, fixed cost. Fixed cost is, let's say, 50,000, right? And then we have like, EBIT, earnings before interest and tax, is 70,000. Out of this, you're paying an interest of 30,000, which will give you a profit before tax of 40,000. Then you pay tax out of it, let's say 12,000, which is tax at the rate of 30%. They'll give you a profit after tax of 28,000. I hope everyone is following this income statement. I hope everyone is aware of the terms that I have used in this income statement, right? You all are aware of the terms that we are using in the income statement, correct? Right, guys? Now my question to you is, suppose sales unit increase by 10%. sales units are increasing by 10%. So let's say instead of selling 10,000 units, next year you're going to sell, let's say 11,000 units. Rest all remaining same. Just the sales units are increasing from 10,000 to 11,000. Rest everything is same. Can you prepare this entire income statement, guys? Can you prepare this entire income statement? Yes? Sure. Prepare this entire income statement, guys, quickly. Prepare this entire income statement, guys. Right from sales till profit after tax. Or rather, I'll do one thing. Let me add, divide by number of equity shares so that we get EPS. So number of equity shares is, let's say, 5,000. So this is going to be EPS is 5.6. Yeah. So sales units, when your sales units increases from 10,000 to 11,000, what is the value of EPS? Yeah, just prepare this entire income statement. Yes. So sale price will be 20, variable cost will be rupees 8, but the sales is going to be now 2,20,000. Variable cost will be 88,000. Contribution is 1,32,000. Fixed cost will remain fixed. Right? Fixed cost is going to remain fixed. There's no change in the fixed cost. Then we have EBIT of 82,000. Interest payment will continue to be 30. PBT is now 52,000. Tax rate is 30%. 52,000 into 30%. So 52,000 into 30%, that is 50,600. Profit after tax is going to be 36,400. Number of equity shares is 5,000. So the EPS stands as 36,400 divided by 5,000. 7.28. Right, guys? Are we getting these numbers? EPS 7.28, guys. Did we get this? EPS, everyone? Yeah. Okay. So now my task for you is calculate the percentage changes every time. Like by what percentage has the sales changed? By what percentage the variable cost has changed? By what percentage the contribution has changed? By what percentage fixed cost has changed? By what percentage EBIT has changed? By what percentage interest has changed, PBT, tax, PAT. There's nothing about number of equity shares. But yes, this is going to be what percentage. Yeah. Get these percentages, guys. Percentage changes. You'll see some wonders happening. You'll see some wonders happening with this. Just check with these percentage changes. Check these percentage changes, guys. Yeah. By what percentage do you see the percentage changes? Just check. Calculate the percentage changes, guys. Yep. Just check the percentage changes. Sales is going to change by same 10%, guys. Sales is changing by 10%. It's becoming from 2 to 2 lakh 20. So there's an increase of 10%. Variable cost is also increase of 10%. Contribution is also changing by 10%. Fixed cost isn't changing. But what's the change in EBIT, guys? So 82,000 minus 70,000 divided by 70,000. So that's 17.14%. Interest, there's no change. And PBT now changes by 12,000 divided by 40,000, which is 30%. Tax changing by 30, PAT changing by 30, and even EPS is changing by 30%. Got it? Are we getting these percentage changes? Are we all getting these percentage changes? Yes. So, can I say over here now that for 10% change in sales, it is causing for 10% change in sales is causing 17.14% change, 17.14% change in EBIT, 17.14% change in EBIT, and that is actually causing 30% change in EPS, right? Or you can also say that if you're changing sales by 10%, your EBIT is changing by 17.14%, and that is leading to even a 30% change in EPS. So is it a good thing or is it a bad thing? Okay, whether it is good or bad, that's a separate thing. That's a separate discussion which we'll have. But the idea is for any change that is happening in sales, there is a resultant impact on the EBIT and also on the earnings per share, right? So now, when we're asking for operating leverage, when we're trying to measure the operating leverage number, which is again a measure of operating risk. So that operating leverage is calculated as percentage change in EBIT due to percentage change in sales. Percentage change in EBIT upon percentage change in sales. So we can say EBIT is changing by 17.14% and sales is changing by 10%, which is 1.714 times. So operating leverage is percentage change in EBIT upon percentage change in sales, which is 17.14% upon 10%, which is 1.714 times. How do we interpret this 1.714 times? It means for 1% change in sales, we will observe 1.714% change in EBIT. So the risk sensitivity, or you can say the elasticity of EBIT with respect to sales is operating leverage. So operating leverage is a measure of operating risk as to for 1% change in sales, what is going to be the impact on the EBIT. Now, higher this number means higher is the risk that you are undertaking, right? Higher this number, higher is the risk that you are undertaking, because for 1%, for one small change in sales, if it is leading to very high change in the EBIT, then it's something which is problematic, right? So operating leverage, we say percentage change in EBIT upon percentage change in sales. So percentage change in EBIT is 17.14 and sales is 10%. So we say that the operating leverage is 1.714 times. Okay. Done? Are we clear, everyone? Yes. Okay. Now, similarly, we'll have something called as financial leverage. Financial leverage is percentage change in EPS due to percentage change in EBIT. So EPS changed by 30%, EBIT changed by 17.14%. So this is 30 divided by 17.14. That's 1.75 times. Now 1.75 times. This simply can be interpreted as for 1% change in EBIT, we will observe for 1% change in EBIT, we will observe 1.75% change in EPS. Or I can say EPS is going to be 1.7 times. Change in EPS is going to be 1.75 times of the change in the EBIT that we are observing. Okay, got it? Yeah, that's your financial leverage. So one thing is we had the operating leverage. The other aspect is we are having the financial leverage. So operating leverage is going to measure the percentage change in EBIT due to percentage change in sales. Financial leverage is going to measure the change in EPS due to change in EBIT, which is 1.75 times. And obviously the operating leverage is 1.714 times. Now, these are like the sensitivity measures. One more sensitivity measure that we have is combined leverage. Combined leverage is percentage change in EPS due to percentage change in sales. So percentage change in EPS, percentage change in EPS is 30%, whereas percentage change in sales is 10%. So this is 3 times. So how do we go about understanding this 3 times? This 3 times mean for 1% change in sales, there will be 3% change. So for 1% change in sales, there will be 3% change in the EPS. Or I can say EPS is 3 times. EPS is 3 times, change in EPS is going to be 3 times as compared to, the sales value, right? So we are actually able to work on the leverage. Leverage is like, you put over here, you put 1% effort against which you are getting 1.714% result. With regards to financial leverage, it's like you are putting 1% extra efforts, that is giving you 1.75% of extra result. And on a combined basis, we can say 1% change in sales is going to lead to 3% change in the EPS. Okay. Right? Are we clear, guys? Are all the 3 ratios clear to everyone? Operating leverage, financial leverage, and combined leverage. All of them are simply measuring the degree of change in one variable due to a change in the another variable. Now my question is, why is this leverage coming in? Of course, this leverage is coming in because of fixed costs. So there are 2 fixed costs which the company is actually having. One is a fixed cost, which is the operating fixed cost. Another is a financial fixed cost. Now, financial fixed cost is the interest amount. There is no change in that. And that's where the chain breaks, right? So initially you have 10% for sales, variable cost contribution. But after you cross the fixed cost barrier, the EBIT change becomes 17.14%, right? And when we look at the factors affecting after okay, when you look at the numbers after interest, what we observe is we get 30%, right? We're getting the answer as 30%. So there are 2 things because of which the leverages are happening. One is the operating cost, operating fixed cost, which is a 50,000 figure, and there is a finance fixed cost, which is 30,000. So numbers before and after are obviously going to be different. So before fixed cost, it was like 10%. After fixed cost, it becomes 17.14. Before interest, it was 17.14, and after interest, it is 30%. Okay. So what we observe here is that this leverage is essentially helping us to measure the risk that we have in a particular company. Now, that risk that we are having is essentially going to be covered, or it's going to be result of the fixed cost that we are having. That may be operating fixed cost, or that may be a financial fixed cost. Now, operating and financial fixed cost are going to be the key player while deciding, whether we are talking of the operating leverage or financial leverage, or we are looking at it in totality as a operating as well as financial, the combined leverage, right? So all these numbers of leverages are essentially telling us how much risk the company has undertaken in the operations part, and another is the financial part. And combined leverage is the total effect of both of them. Okay. Now, since we have calculated the operating leverage by the very basic formula of percentage change in one variable due to percentage change in another variable, we have that as 1.714, 1.75, and 3 times. Let's try to make it even more simpler with some more simpler formula to calculate operating and financial leverage. Right? The basic formula remains the same, which is operating leverage. You can also say that this operating leverage is nothing but, I hope you guys have already learned something called as differentiation or derivatives in your foundation. So there you might have learned something called as derivative of y with respect to x, right? So same way, operating leverage is actually derivative of, change in EBIT, derivative of EBIT with respect to sales.
Mr. Jagabandhu,
term financial leverage, this is actually a derivative of EPS with respect to EBIT. right? And then finally, combined leverage is the derivative of EPS with respect to sales. Right? So all the three numbers are basically your derivative numbers, but we are just trying to understand it in a more intuitive way, which is like understanding what will be the impact on the output variable, which will be the sale value. Output variable would be like your EBIT, the EPS, right? With a change in the input variable, which is your sales. So as the sales changes, we are looking at what is the impact on the EBIT, then what's the impact on the EPS, right? And that's where we are trying to measure the risk of the company. Higher the operating leverage or financial leverage or combined leverage, greater is the risk that the company is undertaking. Okay. Now the question to you is having a leverage, basically having fixed cost in your business, fixed finance cost or operating cost. Is it something which is good or is it something which is bad? Is it something that is good or is it something that is bad? Yeah. Is it something that's good or is it something that is bad? Both ways, right? It can be good, it can be bad. Like, for example, we have considered over here a 10% increase in the sales. Now, what if I'm asking you, just check the impact of a negative 10%. If the sales can increase by 10%, sales can actually decrease by 10% also. So if the sales is going to decrease by 10%, the quantity of sales will become 9,000. Selling price and variable cost, we are just keeping it constant. So now the sale value will be 1,80,000. Variable cost will be also 72,000, which will give us a contribution of 1,08,000. Fixed cost will continue to be 50,000. Fixed cost is going to continue to be 50,000. So your EBIT will work out to be 58,000. Then, since your interest cost will continue to be 30 because it's a fixed cost, then you have a PBT of 28,000. Now, 28,000 is the amount of PBT. On that, we are going to pay 30%. So 28,000 into 30%, that's 8,400. And what you observe is PAT is going to be like 19,600. And when you divide it by 5,000, that's going to be 3.92. So what we observe is this 5.6 has reduced to 3.92. So 5.6 minus 3.92, this divided by 5.6. So there's a reduction of 30%. So it's like if you are putting in extra efforts to increase your sales, all your numbers are also going to increase, like your EBIT, like your PBT, your PAT, your EPS, everything is going to increase. But if you are a little bit lethargic, and you just stop taking into account the ill effects of leverage, then what you observe is when you're putting 10% less effort, the resultant impact on EPS is going to be substantial, translating to negative 30%. That's what we talk of risk, right? So risk is like you can actually get a higher rate of return, or you can even go for lesser returns. That's where this risk is. And the other name for risk is definitely leverage, right? So leverage is going to be a measure of risk. As we said, three types of leverages: operating, financial, and combined. They are simply going to measure the risk for 1% change in the input variable. What will be a change in the output variable? The input variable can be sales, and the output variable can be EBIT and EPS. Okay, so we have seen this typical formula. Now let me just put in front of you a simpler versions of this formula. Okay,
Mr. Jagaban,
simpler versions of this formula. Now, simpler versions of this formula would be, like
Dr. Sengupta this side.
Operating leverage. So we calculate operating leverage. how are we going to calculate the operating leverage number, guys? How are we going to calculate the operating leverage? Operating leverage will be calculated as percentage change in EBIT upon percentage change in sales. Remember, percentage change in EBIT upon percentage change in, like whatever percentage change you're observing in the value of sales, in the value of contribution, in the value of variable cost, all three are one and the same. So can I say percentage change, whatever is happening in the sales, that's exactly the same percentage change that we have in the contribution. So we'll say percentage change in sales is same as percentage change in contribution. Okay. Now percentage change in EBIT. How did we calculate this percentage change in EBIT? We calculated this percentage change in EBIT as EBIT of year 1 minus EBIT of year 0. EBIT of year 1 minus EBIT of year 0 divided by EBIT of year 0. Then this whole divided by contribution of year 1 minus contribution of year 0 upon contribution of year 0. Okay. So let me just rearrange these terms then. EBIT 1 minus EBIT 0 upon contribution 1 minus contribution 0 multiplied by contribution in time 0 upon EBIT in time 0. Just observe EBIT minus and difference between EBIT. The difference between EBIT is 12,000. And the difference between contribution, which is 132 and 1,20,000, difference between contribution is also 10,000. Sorry, 12,000. So, can we essentially say that EBIT 1 minus EBIT 0 is 12,000, and in fact contribution 1 minus contribution 0, that's also 12,000, which can essentially mean we can simply cancel these two and we are left with just contribution upon EBIT. That's the formula for degree of operating leverage. So for degree of operating leverage, we can say it is contribution upon EBIT. Okay. Did we get this, guys? Degree of operating leverage. Simple formula or a shortcut formula for that works as contribution upon EBIT. Same way, we can have degree of financial leverage. So financial leverage is calculated as EBIT upon PBT. Okay, by the way, just try to verify it. Contribution upon EBIT. Contribution was 1,20,000 divided by 70,000. So 1,20,000 divided by 70,000, which is 1.71 times. Financial leverage is EBIT upon PBT. So EBIT is like 70,000 upon a profit before tax of 40,000. So 70,000 divided by 40,000, which is 1.75, right? Same way, we can get the combined leverage formula. The shortcut for combined leverage formula is contribution upon EBIT. So contribution upon EBIT, contribution is 1,20,000 upon EBIT is 70,000. Sorry, contribution upon PBT, my bad. Contribution upon PBT, which is 1,20,000 upon 40,000, which is 3 times. So you get the answer similar to what you get in a regular thing. So in the regular formula, whatever answer you apply, that's the same thing what you're getting over here also, but it becomes more easier to calculate. Are we clear with this, everyone? Yep. Shortcut formula are clear, along with the more detailed formula that we covered. Are we good, guys? Yes. Perfect. Okay, then let's do one thing. Since we have done the formula, let's just now take a. Can it be? Yes, combined Neeraj, you're absolutely correct. Combined leverage will be equal to financial leverage into operating leverage. That's absolutely correct. So we can say combined leverage is operating leverage into financial leverage. Yes. So with that in mind, let's just take a break right now, 15 minutes, and then we will continue or start with the questions based on the leverages. Okay. Right, guys. So let's take a break right now, guys.
Now, let us go for certain numericals on leverages. Okay, now just get out from here.
Okay. Let's take up some questions for practice for the topic of leverages. Okay, leverages. 43, 1 second. Just put up the question. Okay, so here we have this particular question. So, following information available for 4 companies. We have to calculate the EBIT, EPS, operating leverage, financial leverage, and combined leverage. So let me just write it down as company P, Q, R, and S. So here we have like sales quantity given to us, which is 20,000, 25,000, 30,000, and 40,000. Sale price per unit is given as 15, 20, 25, and 30. Okay, that's your sale price per unit. We also have variable cost per unit. Variable cost per unit is 10. $15, $20, $25. So we'll start with like sales figure. Sales will be 20,000 quantity multiplied by selling price of 15. So 20,000 into 15, that will be 3 lakh for company P. I'll just do the numbers for company P, and I'll expect obviously to do QRS, PQR, other 3 companies by you. So less variable cost, right? So variable cost will be the variable cost per unit, which is 10, multiplied by number of equity shares, which is 5,000. So 10 into 5,000. Variable cost is sorry, not 10 into 5,000. That's 10 into 20,000. My bad, guys. So 10 into 20,000, that's 2 lakh. Then you have contribution. Sales less variable cost of 2 lakh. Contribution is 1 lakh. Less fixed cost. Fixed cost is 30,000. That will give you EBIT. So 1 lakh is the contribution. Less fixed cost is 30,000. EBIT will be 70,000. And then we subtract the interest.
interest is 15,000, which gives us a PBT of 55,000. So PBT is 55,000. From that, you subtract the tax. Now, tax is at the rate of 40%. So, how much will be the tax amount? 55,000 into 40%. What is the amount of tax? 55,000 into 40%, which is 22,000. It gives you a profit after tax of 33,000. This will be divided by number of equity shares. So, number of equity shares is 5,000. So, we get a EPS number. What's the EPS number? EPS will be 33,000 divided by 5,000, which is 6.6. Right. So that's the EPS. So we got the EBIT, we got the EPS. Now operating leverage, financial leverage, and combined leverage. So operating leverage will be contribution upon EBIT. Financial leverage will be computed as EBIT upon profit before tax. And then combined leverage is contribution upon PBT. So operating leverage contribution is 1 lakh. 1 lakh divided by EBIT of 70,000. 1 lakh divided by 70,000, which is 1.4286. Then financial leverage is EBIT upon PBT. So EBIT is 70 upon 55. 70,000 divided 55,000, 1.2727. Combined leverage will be EBIT of 70,000. So contribution divided by PBT. Contribution is 1 lakh divided by PBT of 55,000. So that's 1.8182. These are the leverages numbers, guys. Right? Can you similarly calculate for Q, R, and S for the other three companies? Can you prepare the income statement and calculate the leverages for the other three companies? Can you do it, guys? Can we calculate it for the other three companies? Yes or no? Yes. Okay. So just go ahead, guys. Complete this for companies Q, R, and S. So meanwhile, I'll just continue with this. So sales is now going to be equal to 25,000 into 20. So sales is 5 lakh. Variable cost is 25,000 into 15, which is 3,75,000. So 5 lakh minus 3,75,000 will give us 1,25,000. Fixed cost over here is 40,000. That's 85,000. Interest will be 25,000. So we have PBT of 60,000. Now on that 60,000, we are going to pay a tax of 40%, which is 24,000. And this is 36,000. This is going to be divided by number of shares of 9,000. And so which 36 divided by 9, that's 4. EPS is 4 rupees. Right? For company Q, EPS is 4 rupees, yes? Are we getting an EPS of 4? Yes. Okay, so then we have the operating leverage, financial leverage, and combined leverage. Operating leverage will be 1,25,000 divided by 85,000, which is 1.47. Then financial leverage will be 85,000 divided by 60,000, which is 1.42. And then finally, it's going to be contribution of 1,25,000 divided by PBT of 60,000. So this is 2.08. Right? Okay. Sure. Go ahead with company R and S, guys. Okay, for company R, can you just confirm what are the operating, financial, and combined leverage? Yeah, can you please tell the operating, financial leverage, and combined leverage for company R? For company R, operating leverage 1.5, financial leverage 1.54, and combined leverage is 2.31. What about the last company? What about the last company, guys? The last company, what are the values for last one? 1.43, 1.4, and 2. These are the leverage numbers, operating, financial, and combined leverages. Okay, shall we go for the next question? Yep. Okay. Then in that case, let's try to solve this question. Yes. This is a really interesting question. Okay, look at this question. From the following, prepare income statement of company A, B, and C. Briefly comment on each company's performance. So I'll do the company A, then company B and C, you should be able to do it. So if you look at this question, we have to prepare the income statement, then comment on the performance. So let's first focus on preparing the income statement. Now, how do we go about preparing the income statement over here, guys? So how do we go about preparing the income statement? Let's just prepare the draft of income statement first, and then we'll look at the leverage and other ratios for calculation. So we, start with sales. From that, we'll have variable cost. Then we have contribution less fixed cost, which will give you EBIT, less interest, which gives you PBT, less tax, which gives you PAT. Right? We don't have anyways the income statement. we don't have the number of shares either. So we did not go to all the way up to EPS. So now, as far as these numbers are concerned, we have financial leverage number. We have an interest number of 200. So interest is 200. Apart from that, all other things are in the form of ratio. Right? So now connected with interest, we know which leverage is related with interest. Yeah. Which leverage is related to interest? Financial leverage, right? So let's use that financial leverage number. So we say since financial leverage, what is the number? What's the count of financial leverage? Financial leverage given as 3:1. So financial leverage of 3:1. Now, how do we get this financial leverage? Financial leverage formula is EBIT upon PBT is 3. So this is going to be like EBIT upon EBIT minus interest is 3. Right? So EBIT upon EBIT minus interest is 3. Now we know the amount of interest. So we have EBIT upon EBIT minus interest is 200 is equal to 3. Therefore, EBIT is equal to 3 times of EBIT minus 600. So we get 600 on this side, and then we have 3 EBIT upon minus EBIT. So this 600 is equal to 2 times of EBIT. So we get the EBIT number to be equal to 300. So we got the EBIT of 300. Now, since you know EBIT is 300, we can calculate the PBT to be 100, tax rate is 45, and PAT is 55. That's pretty simple. Now, once we have got the EBIT, we can actually work with the operating leverage. So, operating leverage is given as contribution upon EBIT. Contribution upon EBIT. So, operating leverage is given as 4. So, 4 is equal to contribution upon EBIT. Now, we don't know what is the contribution, but we definitely know the amount of EBIT is 300. Therefore, contribution is 1200. Contribution is 1200. Okay. Contribution is 1200. Now we obviously say that Fixed cost is 900, which is the balancing figure. One last thing left out is variable cost as a percentage of sales is 66 2 by 3. Variable cost upon sales is 66 2 by 3%, which is nothing but 2 by 3 itself. So I can write this variable cost as variable cost to sales is 2 by 3. Therefore, what will be contribution to sales number? If your variable cost to sales ratio is 2 by 3, what can you say about contribution to sales number? Contribution to sales number. Can you say it will be 1 3? I mean 1 by 3rd. So contribution is 1200 upon sales is 3. Upon sales is 1 by 3. Therefore, sales will be equal to 3600. So we say sales is 3600 and variable cost is 2400. Okay. Done? Is it clear, everyone? Are we clear with this, everyone? Yes. So can you do the similar thing for company B and C? Can you do it? Same method for B and C, yes. Please explain last part. Well, last part is the question stated that the ratio is variable cost to sales is 66 2 by 3%. So it is like this: sales less variable cost and then contribution. If sales is 100, 66 2 by 3 is variable cost. So 33 1 by 3 is contribution. Right? So that is contribution upon sales is this number. So since we have contribution 1200, we can get the sales of 3600. Okay. Okay. Sure. Do it, guys. Do it for company B and C now. Same procedure. So what is the sale value for B? It's 8,000. And sale value for C is 12,000. Just verify, guys. Just verify, guys. Are you getting a sales of 8,000 and 12,000? Yes. So contribution 2,000, 6,000, EBIT 4,000, 2,000. Okay. Perfect. So that's absolutely right. Now let's take up one more question. Okay. So next, 1 second. Next question. Let me just take up this question for you. Okay, so this one. Here is the question. So we have no information is given in this, but we just have the information of profit after tax of 25,000, 40,000. Operating leverage is given as 2 and 4 first one, and 60% of sales is the variable cost for the first company. And for the second company, we have the profit after tax as 40,000. Operating leverage is 3, and combined leverage is again 3. Variable cost ratio is 70% of the sales. Will you try this question, guys, to complete the income statement? Will you try this, or shall I solve it? We have to do the reverse calculation, backward calculation. Can we do it? Would you like to attempt it? Yep. Everyone? Yes? Okay. So good, guys. I'll just give you maybe just to quickly solve it. Just a 5-minute timer I may set. Okay, let me just put up a 5-minute timer for you. Okay, so try to solve it quickly, guys. 5 minutes. Okay, so for L, you obtain the sales. For M also is the sales. Okay, so we have the profit after tax figure. From that, we are supposed to be calculating all the previous numbers. So let me start with profit after tax. So profit after tax of 25,000 and 40,000. We can get the PBT as PAT divided by 1 minus 0.5. It is 25,000 divided by 0.5. So PBT is 50,000 and 80,000. Then to that, we are going to add interest so that we get earnings before interest and tax. Now we don't know what is interest, what is EBIT, but one thing we know is that combined leverage and operating leverage is given. From combined leverage and from operating leverage, we can definitely calculate the amount of, the number of financial leverage. So let's do that first. So for both companies, we have operating leverage and combined leverage. So operating leverage is 2 and combined leverage is 4. Here it is 3 and 3. So financial leverage will be combined leverage divided by operating leverage, which is 2 and 1. Okay, so it's going to be 2 and 1. Now, since financial leverage is equal to EBIT, EBIT upon PBT. Therefore, we have the PBT number and EBIT will be PBT multiplied by financial leverage. So here we are going to have, like, we know the financial leverage is 2 and 1. So PBT into 2. So EBIT is 1 lakh. And there it is 80,000. So interest is basically 50,000 and there's no interest over here. So we got the EBIT. To that we will add fixed cost. Do we have the information of fixed cost? No, but do we have the amount of operating leverage? So we can get the contribution. So we can get the value of contribution, right? So well, the contribution value is going to be Oh, it's got some muted anyways. So degree of operating leverage, it is percentage change in EBIT upon percentage change in sales. Degree of financial leverage is percentage change in EBIT upon percentage change in EBIT. Sorry, percentage change in EPS upon EBIT. And degree of combined leverage is percentage change in EPS upon percentage change in sales. Okay. So we also know that degree of combined leverage is nothing but degree of operating leverage into degree of financial leverage. Okay. With regards to degree of operating leverage, we also have the formula of contribution upon EBIT, and degree of financial leverage was EBIT upon PBT, and degree of combined leverage was contribution upon PBT. Now, this degree of financial leverage is something, which is going to be different if preference dividend is payable. So, if preference dividend is payable, degree of financial leverage will be something different, guys. Now, it's not going to EBIT upon PBT. The formula is going to be slightly different. Now, what is that different formula? That is what we are going to discuss in the next session, which we are having on the next week. That's on Friday. So on Friday, we'll be completing this topic of financial leverage. Okay. Right now, I just open up the platform for you to ask any queries if you have. Any sort of queries you have, guys, you're free to ask. Any queries you have, you can ask. Yep. Any queries, guys? You have to ask me. You're free to ask any queries. We still have got a few minutes left. Upload assignment notice. Yes, I'll be uploading some additional questions and solutions also. Shivam, how do leverage help in decision making? Leverages help you to make decision making by the way that you're going to take some amount of risk when you are incurring some sort of fixed cost. So when you're incurring some sort of fixed cost, there is some risk that you're undertaking. So whether you're capable to bear that risk or not, that depends on relation between your return on capital employed and the rate of interest and rate of preference. So we need to look at whether the return on capital employed is more than my cost. Then it will be something which will be beneficial for you. If your return is low and you're still having fixed cost with you, if your sales are lower, your EBIT is lower, and still you have like high interest and high fixed cost, then that means you are actually suffering from a problematic situation, which may lead to a not so favorable situation for you. Okay, so it's a measure of risk. It helps you to understand how much risk the company has undertaken in its business. Okay, any other queries, guys? Leverage is a measure of risk. It's just a change in one income due to the change in the other income, other parameter. So I want to know what is the sensitivity, how much percentage change is going to be there in EBIT due to change in sales, how much percentage change is going to be EPS in percent due to change in EBIT. So whatever is the change in input, what is the resultant impact on output? That is what this leverage talks about. Any other queries, guys? Okay, so no queries. Then in that case, let's just
stop here for the day, guys. Yep. So good night, guys. See you next week. Next week we'll be completing this topic of leverages. Bye bye, guys. Enjoy. Take care. Yes.